In today's digital world, data is everything, and dates are a critical part of that data. But what happens when an electronic system misinterprets a date? That's where the Electronic Date Recognition Clause, also known as EDR Clause in short, comes into play. Whether in insurance policies or commercial contracts, this clause ensures that systems can handle dates correctly and limits liability when they don't. Welcome to Insurance World TV, the channel where we break down complex insurance concepts into everyday language so you can protect what matters most. Today, we're diving into a topic that sounds technical but plays a surprisingly important role in your policy, especially in this digital age. It's called the Electronic Date Recognition Clause, or EDR Clause. What is it? Why does it matter? And could it be the hidden reason your insurance claim might be denied? Stay tuned. In the next few minutes, we'll unpack what the EDR clause really means, where it applies, and why it still matters long after the year 2000 bug. Let's get started. Question 1. What is an electronic date recognition clause? An electronic date recognition clause, sometimes referred to as a date recognition clause, is a contractual provision found in insurance policies, service agreements, and technology contracts. Its main purpose? To ensure that electronic systems handle dates correctly and consistently. It became especially relevant during the year 2000 scare, when it was discovered that many systems only recognized years using 2 digits, i.e. 98 for 1998 and 89 for 1989, thus making 00, which was meant to represent the year 2000, appear as 1900, which caused critical system failures. Key components of an EDR clause. 1. Date format specification. For example, requiring all dates to be entered as year/month/date, rather than month/date/year. 2. Year representation. Mandates full 4-digit years to avoid confusion, e.g., 2025, not 25. 3. Leap year handling. Ensure systems correctly account for February 29th and leap year calculations. 4. System functionality assurance. Systems must be able to process, store, retrieve, and interpret date information accurately, across time zones and updates. Real-world applications of EDR clauses. 1. Insurance policies. Many insurers include EDR clauses to exclude coverage for claims related to software malfunctions due to incorrect date recognition and failures related to the year 2000 bug, Y2K, or similar future bugs. 2. Commercial contracts. Contracts may include EDR clauses in time-sensitive agreements where digital timestamping is crucial. Electronic signature platforms. Delivery deadline enforcement. 3. General liability policies. Some general liability insurance policies use EDR clauses to limit exposure for damages caused by failure to process digital data, loss of electronic records due to misinterpreted date formats. Why it still matters today. You might think the EDR clause was only relevant around the year 2000. But think again. As businesses and governments adopt AI, IoT, blockchain, and digital contracts, proper date recognition is more important than ever. An error in how a contract date is interpreted, say, thinking 01/07/25 is January 7th instead of July 1st, could cost millions. Question 2. What exactly does an EDR clause do? An electronic date recognition clause sets clear rules for how electronic systems and software should handle dates, and this is more important than it sounds. For example, it ensures that century transitions are handled correctly, like moving from 1999 to 2000, or in the future, from 2099 to 2100, without systems crashing or interpreting the date incorrectly as 1900. It also covers leap year recognition. Computers need to know that February 29th exists every 4 years, or financial calculations, billing cycles, and scheduling systems could go wrong. And lastly, it defines the date format, which might seem small but can cause big issues. For example, is 01/07/25 the 1st of July or January 7th? An EDR clause removes that ambiguity by specifying a standard, like YYYY/MM/DD, so everyone and every system is on the same page. In short, this clause makes sure your systems know what date it is, what it means, and how to use it properly, minimizing costly errors or disputes. Question 3. How does the EDR clause apply in insurance contracts? In insurance, the electronic date recognition clause plays a very specific and very strategic role. It's often included to limit or exclude coverage for losses caused by failures in electronic systems that can't handle dates properly. Let's break that down. Imagine a policyholder runs a business that depends on automated systems for billing, security, logistics, or even medical equipment. If one of those systems crashes because it misinterprets a date, say, it reads the year 2025 as 1925, that could lead to major losses. Now, without an EDR clause, the insurer might be forced to pay for business interruption losses, equipment failure, data corruption, or even third-party liability. But with an EDR clause, the insurer can say, "Sorry, this was a system error related to date recognition, and we've excluded that kind of risk from this policy." Where you'll find EDR clause. Property insurance. To avoid paying for breakdowns due to faulty software clocks. Liability insurance. To exclude legal responsibility if your system causes another business harm due to a date glitch. Professional indemnity or tech E&O policies. To clarify that system failures from poor date handling aren't covered, unless specifically added back in. In short, the EDR clause is a risk control tool. It helps insurers clearly define what's covered and what's not when electronic systems get confused by the calendar. Question 4. What is the purpose of the electronic date recognition clause? The EDR clause might look technical, but its purpose is very practical and very important. Let's start with clarification. In digital systems, something as simple as a date can cause serious problems if misinterpreted. Is 03/05/25 March 5th or May 3rd? That depends on the format being used, and without clarity, you risk miscommunication, delays, or even legal disputes. The EDR clause removes this ambiguity by clearly defining how dates should be entered, read, and processed, ensuring everyone's on the same page. Next, protection. Date errors aren't just annoying, they can be expensive. Imagine a software that reads the year 2025 as 1925, and suddenly, your system refuses to process transactions or miscalculates interest, contracts, or payroll. For insurers, this clause provides a layer of legal protection, helping them exclude or limit liability for claims caused by such electronic failures. For businesses, it clarifies responsibilities and shields them from disputes over who's at fault. Finally, standardization. We live in a connected world where data flows between servers, platforms, and apps across the globe. Without a standardized approach to date recognition, systems can fail to talk to each other properly. The EDR clause ensures that all platforms, whether financial, legal, or operational, follow one uniform date handling method. This improves efficiency, reduces errors, and boosts system reliability. Question 5. Why is the EDR clause sometimes included in an insurance policy? While an EDR clause is typically used to exclude coverage for losses caused by electronic date issues, like system failures due to Y2K style bugs, there are situations where insurers choose not to exclude it. Here are some of those situations. 1. Modern systems are more resilient. Today's technology has come a long way since the panic of the year 2000. Most modern systems are built to handle 4-digit years, leap year calculations, and date-sensitive processes. So, insurers may deem the risk of date-related failures too low to justify a blanket exclusion. 2. Competitive advantage. In markets with stiff competition, including the EDR clause can be a selling point. Insurers may want to show clients they're offering more comprehensive coverage, especially in sectors like IT, banking, or logistics, where reliable date processing is critical. It creates trust and confidence in the policyholder that the insurer won't deny claims on a technicality. 3. Customized coverage or endorsements. Some clients negotiate for broader coverage or purchase special endorsements to protect against electronic failures, including date recognition errors. In these cases, the standard exclusion is removed. The insurer may instead charge a higher premium or apply specific sublimits for date-related risks. 4. Changing risk landscape. In an increasingly digital world, electronic risks are now seen as part of general cyber or technology risk pools. Instead of using EDR clauses, insurers may bundle date-related exposures under cyber insurance, which is more tailored and specific. Bottom line, an EDR clause is sometimes included when 1. The risk is considered minimal or outdated. 2. The insurer wants to stay competitive. 3. The client has negotiated broader coverage. 4. The issue is addressed under a different policy, like cyber insurance. In summary, an electronic date recognition clause is a risk management tool, a safeguard against electronic system failures, a standardization mechanism for date handling, and a potential exclusion clause in insurance. Whether you're in IT, insurance, legal, or contract management, understanding EDR clauses can help you avoid costly errors and ensure your systems stay future-ready. This clause is a crucial provision in many insurance contracts and commercial agreements. It defines how electronic systems should process dates, covering things like century changes, leap years, and standard date formats. Its main purposes are 1. Clarification, to avoid ambiguity in date interpretation. 2. Protection, to limit insurer liability for system failures caused by date misreads. 3. Standardization, to ensure consistent data processing across platforms. It commonly appears in property insurance, general liability, cyber insurance, and professional indemnity policies, especially where digital systems play a critical role. In a world where everything runs on data and dates, the EDR clause is more relevant than ever. It helps insurers manage risk and sets clear boundaries on what's covered and what isn't when date recognition issues cause problems. Pro tip for professionals. If you're reviewing a contract or insurance policy, always check for an EDR clause. If it's missing, ask why. And if it's included, understand what liabilities it protects or excludes. It could be the fine print that saves your system or sinks your claim. This has been Insurance World TV, where we make insurance simple, practical, and powerful. Don't forget to like, share, and subscribe. See you in the next video.